Most people think billionaires became rich because that they worked harder than everyone else. But if hard work alone created billionaires, construction workers and nurses would be some of the richest people on Earth. The real reason many billionaires continue getting richer has more to do with ownership than effort. Because in the modern economy, labor and assets are rewarded very differently. Most people earn money from wages. They work a job, receive a salary, and use that income to pay for housing, food, transportation, and daily expenses. Their financial growth usually depends on raises, promotions, or working more hours. But billionaires rarely depend on salaries. Most of their wealth comes from owning assets like stocks, businesses, real estate, or investment funds. And that difference matters more than most people realize. For example, when a company's stock price increases by 10%, shareholders benefit immediately. If someone owns billions of dollars worth of shares, even a small increase can generate enormous wealth in a very short period of time. That's why people like Jeff Bezos or Elon Musk can gain billions in net worth within a single year without receiving a massive salary. Their wealth is tied to ownership. And over the last few decades, asset prices have risen much faster than wages. Since the early 1980s, stock markets and real estate values in many countries have increased dramatically. Meanwhile, wage growth for average workers has been much slower when adjusted for inflation. In simple terms, people who owned assets became richer faster than people who relied only on paychecks. And one of the biggest reasons for this is inflation. Most people think inflation only means higher prices at the grocery store or more expensive rent. But inflation also affects assets. When central banks inject money into the economy or keep interest rates low, that money often flows into financial markets. Investors borrow cheaply, companies expand, and asset prices rise. This became extremely visible during the pandemic. Governments and central banks pumped trillions of dollars into the global economy to prevent economic collapse. Interest rates were lowered, stimulus programs were introduced, and financial markets received massive support. As a result, stock markets surged. Real estate prices exploded. Tech company valuations skyrocketed. And because wealthy households already owned most of those assets, their wealth increased rapidly. Meanwhile, many ordinary workers were dealing with layoffs, rising living costs, and inflation that reduced the value of their wages. This is one reason wealth inequality increased during and after the pandemic. The system rewarded ownership more than labor. Another major advantage wealthy people have is access to leverage. Most people think debt is always dangerous. And for consumer debt, that's often true. Credit card debt and high-interest loans can destroy financial stability. But wealthy investors often use debt differently. Instead of borrowing money to consume, they borrow money to acquire assets. For example, a real estate investor might use a bank loan to purchase an apartment building. If rental income exceeds the cost of the loan and the property value rises over time, the investor builds wealth using borrowed money. Large corporations operate similarly. Companies regularly borrow billions to expand operations, buy competitors, or invest in growth. If those investments generate higher returns than the interest they pay, borrowing actually accelerates wealth creation. Ordinary workers usually don't have the same access to low-interest capital or investment opportunities. And this becomes even more important during economic crises. During the 2008 financial crisis, millions of people lost homes, jobs, and savings. But many institutional investors and private equity firms used the crash to buy distressed assets at discounted prices. When housing markets recovered years later, those investors made enormous profits. The same pattern happened during the pandemic. When markets crashed in early 2020, wealthy investors with available cash were able to buy stocks and assets while prices were falling. Then, after stimulus policies boosted financial markets, many of those assets rebounded sharply. In other words, economic crises often create buying opportunities for people who already have capital. Meanwhile, people living paycheck to paycheck usually focus on survival during downturns, not investing. That's why wealth tends to become more concentrated over time. One of the biggest myths about wealth is that rich people simply save better than everyone else. But most billionaires didn't become billionaires by saving money on coffee or cutting back on small expenses. In reality, extreme wealth is usually built through ownership, scale, and compounding. And compounding is where things start becoming very unequal. For most workers, income grows slowly. You might get a small raise every year, maybe a promotion after a few years, and eventually a higher salary over time. But your earnings are still connected to your labor. There's a physical limit to how many hours you can work. There's also usually a limit to how much a company is willing to pay you. Assets don't work like that. If someone owns shares in a company and that company grows globally, the value of those shares can increase far beyond what any normal salary could realistically match. For example, if a company's stock rises from $50 to $500 over several years, early shareholders can multiply their wealth without working 10 times harder. This is exactly what happened with many technology companies over the last 2 decades. People who owned large amounts of stock in companies like Amazon, Apple, or Nvidia saw massive increases in wealth because the value of those companies exploded over time. And the key point is this: the larger your existing assets become, the easier it becomes to generate even more wealth. For example, someone with $10,000 invested in the stock market might earn around $1,000 during a strong year. But someone with $10 million invested could gain over $1 million from the exact same market movement. Both investors earned roughly the same percentage return. But one person gained life-changing wealth while the other gained a small boost. That's how compounding naturally favors people who already own large amounts of capital. And this effect becomes even stronger because wealthy people often have access to investments ordinary people never see. Private equity, hedge funds, venture capital, and early-stage startup investing are usually available only to high-net-worth individuals or institutions. These investments can be extremely risky, but they also give wealthy investors access to opportunities before the public does. For example, early investors in companies like Facebook or Uber made enormous returns long before ordinary retail investors could buy shares publicly. By the time average people gained access, much of the explosive growth had already happened. This creates another layer of inequality inside the financial system. Access itself becomes valuable. And taxes also play a major role in how wealth grows differently for rich people. Most workers are taxed primarily through income. Their salaries are taxed directly through payroll taxes and income taxes before they even receive the money. But billionaires often hold wealth in appreciating assets instead of traditional income. And in many countries, unrealized gains are not taxed until assets are sold. That means if someone owns stock worth billions of dollars and the value keeps rising, they can become dramatically wealthier on paper without immediately paying taxes on those gains. Some wealthy individuals even borrow against their assets instead of selling them. This allows them to access liquidity while avoiding large taxable events. In simple terms, assets can provide both growth and financial flexibility in ways ordinary wages usually cannot. One of the biggest misconceptions about billionaires is that they avoid taxes by hiding money in secret bank accounts. In reality, most ultra-wealthy people use completely legal financial strategies that are built directly into the tax system itself. And one of the biggest advantages comes from how assets are taxed compared to income. Most ordinary workers earn money through salaries, and salaries are taxed immediately. Income taxes, payroll taxes, and other deductions are usually taken directly from a paycheck before the money even reaches a bank account. But billionaires often don't rely heavily on salaries. Many of them technically receive relatively small annual salaries compared to their total net worth. For example, several major CEOs have famously taken salaries as low as $1 per year. That sounds ridiculous at first, but the reason is simple. Their real wealth comes from ownership. Stocks, company shares, investments, and other appreciating assets. And here's where the system becomes extremely important. In many countries, assets are not taxed simply because they increase in value. They are usually taxed only when they are sold. This is known as unrealized gains. For example, imagine someone owns $10 billion worth of stock. If the stock price rises by 20%, their net worth might increase by $2 billion on paper. But unless they actually sell those shares, that gain often isn't treated as taxable income yet. So even though that they became dramatically wealthier, there may be little immediate taxation on that increase. And instead of selling assets, many wealthy individuals borrow against them. This is one of the most powerful financial strategies used by the ultra-rich. Here's how it works. Imagine a billionaire owns billions of dollars worth of stock in a company. Selling those shares could trigger enormous capital gains taxes. But banks are willing to lend money against those assets because the billionaire is extremely unlikely to default. So instead of selling stock, they take out low-interest loans using their shares as collateral. That borrowed money can then fund homes, investments, businesses, travel, or personal spending. And loans themselves are generally not considered taxable income. This strategy allows wealthy individuals to access liquidity while avoiding large taxable events. At the same time, their original assets may continue increasing in value faster than the interest on the loan itself. So their wealth keeps growing even while they borrow against it. This is part of why critics often argue that the tax system treats wealth differently from labor. Workers are taxed primarily when they earn money, asset owners are often taxed primarily when they sell, and if assets are held for extremely long periods of time, taxes can sometimes be delayed for years or even decades. Large corporations also use tax systems strategically. Companies can deduct certain business expenses, use depreciation rules, shift profits internationally, or reinvest earnings back into growth rather than paying them out directly as taxable income. None of this is usually illegal. In many cases, these strategies are openly available within the financial system. The difference is that billionaires and large corporations have access to elite accountants, tax attorneys, financial advisors, and investment structures that ordinary people simply don't. And this creates another major advantage of wealth itself. The more assets someone owns, the more financial flexibility they often gain. That's why discussions about billionaire taxes are usually less about secret loopholes and more about how modern tax systems were designed in the first place. Because in many economies, the system taxes labor very aggressively, while allowing wealth tied to appreciating assets to grow far more efficiently over time. But understanding the system isn't about becoming anti-rich or believing the economy is secretly controlled by a few people behind the scenes. It's about recognizing that modern wealth operates very differently from what most people are taught growing up. Most schools teach people how to become workers. Very few teach people how ownership, investing, capital markets, or asset accumulation actually work. And because of that, many people spend their entire lives focusing only on income while ignoring the systems that quietly build long-term wealth. The reality is that in modern economies, wages alone often struggle to keep pace with rising asset prices. Housing becomes more expensive. Stocks continue climbing over decades. Land grows more valuable. Businesses expand globally, and people who already own those assets usually benefit the most from that growth. That's why wealth inequality keeps increasing in many countries, even when economies are growing overall. Economic growth does not automatically distribute wealth equally. In many cases, growth primarily increases the value of assets first. And since wealthy households already own most financial assets, they naturally capture a larger share of the gains. This is also why many ordinary workers feel like they're falling behind even while markets are performing well. Someone might be working the same job, earning a slightly higher salary than a few years ago, yet still feel financially weaker because rent, housing, healthcare, education, and living costs increased even faster. Meanwhile, asset prices may have doubled during the same period. So the gap continues expanding. And over time, ownership itself becomes one of the biggest advantages in the entire economy. Because once assets begin generating returns, wealth can grow independently from labor. Money starts producing more money. And the larger those assets become, the more powerful compounding becomes over decades. That doesn't mean hard work is useless. Work still matters. Skills still matter. Education, discipline, and opportunity still matter. But understanding how wealth actually grows is just as important. Because many of the richest people in the world are not becoming wealthier primarily because they work longer hours than everyone else. They become wealthier because they own appreciating assets inside a system designed to reward ownership heavily over time. And once you understand that, the modern economy starts making a lot more sense. Not because the system is necessarily fair or unfair, but because you begin seeing the difference between earning money and owning the things that generate it.